Well, good afternoon, everyone, and thank you for joining us for the next webinar series here at Vincents. Today's topic, as you can see, is on transitional CGT relief. So this is essentially a self-managed super fund specific topic relating around the transitional relief measures for capital gains tax. So we're going to be covering a fair bit of content today. Apologies if I do move through things a little bit quickly. There's a fair bit to talk about, but we do have some worked examples sort of near the back end of the presentation. So hopefully that'll sort of help articulate some of the issues that arise through this CGT relief measure. So by way of introduction, this would have to be one of the most complex pieces of legislation that I've had to deal with in 20 years relating to superannuation. And the ironic thing is that after 30 June this year, we don't care about it anymore. So this measure only relates to the 2017 tax year. So once the tax return due date hits for the super fund, it's no longer relevant. So there's been a lot of information, a lot of learning to get to a point where in 5 months' time, we actually won't care about this anymore. And it's learning and, I suppose, process design, development and change, not only for the administrators and the accountants, but also software companies. We've had numerous discussions with software providers around how this works and in a practical sense, and how their systems can actually help accountants do it better. So a little bit of background behind all this. So we have these measures because in the 2016-17 federal budget that was handed down, they introduced a whole heap of superannuation reforms. Now, what we're talking about today is specifically capital gains tax relief, but the reason why we have that is because of the transfer balance cap. So the transfer balance cap, is a very quick summary, is essentially where you have only so much you're allowed to put into into a pension phase. Let me get that right. So you're allowed 1.6 million inside pension phase. So what they've tried to do is make a level playing field essentially for everyone as at 30 June 2017 around historical capital gains tax or unrealised capital gains events. Now, it's important to note that this is an election. It is irrevocable. So in other words, once you start, then once you elect, that's it. You can actually choose on an asset by asset basis, also on a class by class. It's up to you. A trustee needs to keep appropriate records around the election that has been made. And as I said, that happens as part of the 17 financial year, so part of the tax return. Now, the ATO have tried to help by putting out what they call law companion guides. So these law companion guides are essentially their interpretation, their view of how it works, of how the legislation works. So there's around the super reforms, there's probably around 8 of these law companion guides that have been published. The one that specifically relates to the CGT relief is 2016/8. Now, it's about 100 pages. It's a lovely reading, and it is constantly updated. So, in other words, the tax office are making changes to this on a constant basis, which is painful in some ways because it means that you're essentially never actually know what you're dealing with, but that is only their perception. So making the election is actually really straightforward. It is part of the capital gains tax schedule that appears on the tax return. So when you lodge the tax return, you've just got to make sure that on the capital gains tax schedule, these things are actually identified, or basically the yes/no box there is ticked, and if you're deferring any amount, that you put that in there. And that has to be done in line with the due date of the tax return for the self-managed super fund. Now, remembering that a couple of weeks ago, we're all surprised when we discovered that the tax office had extended our lodgement deadlines out to 30 June, which, because that's a weekend, becomes by default 2 July. So essentially 99% of self-managed funds, their due date is now the 2nd of July. The only ones that did not change were large super funds, so over 75 million, I think that is. They're still in 15 January, or were 15 January, and late lodgers were 31 October last year, so they haven't changed. So if you have a client that was a late lodger, according to the tax office, and their return was due 31 October, you actually can't use this relief measure anymore. It's passed for that fund. So eligibility. Essentially, there are two mechanisms or two ways that you can use the CGT relief criteria. So basically, what is known as segregated and proportional. Now, segregated is about where a fund is essentially 100% in pension phase. So, in other words, they had a pension on 9 November 2016 and it stopped being segregated on or prior to 30 June 2017. So if you had a member that was in pension phase prior to 30 June, then prior to 9 November, then potentially you could use the CGT relief measure and eliminate capital gains, because that the 100% pension, it means that they're segregated. So what that means is that there's no notional gain and that the cost base is reset, and you can choose what date you use. So in other words, you can cherry pick the best date between 9 November 2016, and that's when the legislation entered the House of Reps, hence why that date is important, or 30 June 2017. So what we've discovered is that if your client has a large portfolio of banks, for argument's sake, banking shares, around 1 May or 2 May is probably going to be the best date to use for the CGT relief to maximise the capital gains tax. Because ultimately, that's what you're trying to do. You're trying to get the best outcome for your client. Proportional is a little bit different. So there's a bit of a criteria that applies to that. So essentially it means it's not segregated. So either there was a member that had an accumulation balance in the fund, or there were, say, two pensioners, one had an accumulation, one had a pension phase, or was in pension phase. But there's some reason why you have an exempt current pension income percentage greater than 0. So bear that in mind, that there are these two methods, and they have very different results from a tax point of view too. So with proportional, you actually you defer a capital gain. So you're realising a capital gain that sits on the tax return to be paid at some point later on. With segregated, you don't, because it's 100% exempt now. It'll be 100% exempt when you do the relief. With proportional, a portion of the fund is taxable. So a portion of the capital gain that you're deferring is taxable. You don't have to pay it now, and I'll cover off that as we work through. And you'll see that I've also got in there what I call the corridor of uncertainty. There's some potential real traps when you switch between either being segregated to proportional or proportional to segregated. And it may mean that you actually can't use the relief measures. So once again, we'll go through that in a little bit more detail. So let's talk about segregated. So to qualify for the relief, firstly, a member has to have over 1.6 million in an account-based pension, or it could be that they have a defined benefit pension that provides them a special cap of or special value of more than 1.6 million, or the fund is paying a transition retirement income stream. Now, if the fund was 100% in pension phase on 9 November 2016, and it remained in 100% pension phase right up until 30 June 2017, then you've got segregated. If, for argument's sake, they make a contribution into the fund, then you've gone from being segregated to unsegregated or proportional. So that's where the change happens that can cause some issues. So it's important to note the trustee chooses the relief, and it's a deemed disposal. So it's just like you're selling and then rebuying the asset back. The only difference is that you don't physically do it. It's just like a virtual sale. So because the fund is segregated, it didn't pay tax before, it means that by doing this refresh, the CGT date restarts, no capital gains tax at that point, but then going forward, whatever portion of the fund becomes taxable again. So once again, we've got some examples as we work through this that will help explain that a little bit more. And also, as I've mentioned there, that the 1/3 CGT discount period, so if you hold an asset for more than 12 months, the super fund gets a 1/3 discount on their capital gains. That date resets if you use this relief measure. So you wouldn't want to be using the relief, potentially, you wouldn't want to be using the relief measure and then selling an asset within 12 months. Now, there may be situations where you do want to do that. So once again, we'll work through some examples. Excuse me. So selecting the date. Now, as I said, you've got to do what's in the client's best interest here. Just using 30 June isn't necessarily the best result for the client. So the first step is to identify the optimal price during what they call the pre-commencement period. That's between 9 November 16 and 30 June 17. So the best price is the highest capital gain that you can get the fund, or the highest capital gain that the fund can achieve. So run capital gains tax reports to determine what that amount is. Pick the best date based off those. We've developed quite an extensive process around all of this, invested a lot of time, energy and effort in doing it. But what it means is that we get to pick the best result for our client, which I personally think is really important. Then what you need to do is you actually need to overlay what that means from an income tax point of view. So we're talking about capital gains tax, now we're talking about income tax. So, because remember that if a client falls into this situation, they are segregated or exempt from tax up to a particular point, being the cessation date. From the cessation date, so the date you pick for your CGT relief, up until 30 June, they will pay tax on that income. So you need to do a rough calculation, essentially, of what that income will look like, and therefore what the exempt pension income will look like, and the tax they may pay. So there's no point picking a date, say on the 1st of June, if it's going to give you a $500 better result, if it means they're going to pay an extra $1,000 worth of income tax during the year. So what we do is we actually overlay that. So we pick the best CGT dates. So we actually pick 4 dates. And then we overlay the exempt pension income calc to say, right, overall, what gives us the best result? Because that's what we're trying to do. And then once we've done that, you roll back, or you basically do your sale and rebuy of your shares, or your investments, I should say. So every bit of software is a little bit different. We use Class software or Class Super software, so they call it a CGT application, or relief application. So you process that with inside the software. It's relatively straightforward. So as I mentioned, don't just pick 30 June because that's what's easiest, because that is the easiest without question. But ultimately, if you can get your client an extra few $100,000 capital gain relief, then you should be picking an extra date. I've had some where there has moved that much. There's been between 400,000 if I just use 30 June to 600,000 if we cherry pick the best date to do this on, and that includes income tax calculations as well. So with segregated, there is, I suppose, a couple of options that you can choose here. Now, 99% of funds will have what they call the pooled approach. So in other words, the assets belong to the fund themselves. They're not member specific or segregated assets to a pension account. So once you choose the relief, then you get to think, okay, well, what do we get to do with this asset? Do we keep that asset just in the pension account, or do we roll back all the assets? So if you continue to use the segregated method and transfer the shares between, say, two segregated pools, then only those assets that have moved you can use the CGT relief on. And remembering that if your total superannuation balance is greater than 1.6 million, you can't have segregation. With proportional, it basically just means that you reset all your assets, and then the taxing point comes forward from there. So to sort of help explain that a little bit more. So let's talk about option one, where we have an asset that has moved from the pension pool to the accumulation pool. So in this case, we have a house. It was segregated to the pension account, and then as part of using the CGT relief, we've actually moved it to another pool. We've moved it to a segregated current asset pool. So this fund may have had other assets, other shares, whatever it may be, that sit inside the segregated pension account. Because we've moved this asset out, it means that we can actually use the segregated method when we do that, because we've done something to trigger that CGT. So remember, you've actually got to do something to be able to use CGT relief. And that's a really important thing, that it's not typically, I shouldn't say generally, but typically it's not just because you're entitled to it. So when with your cessation date, the date you pick, that is also when you roll back your member account to your 1.6 million, or what will end up being 1.6 million come 30 June 2017. So once again, we have a process around that where we work backwards from the 1.6 million back to where what the member balance was at a particular point in time. And then so that way we end up with 1.6 million as at 30 June 17. So that's another process, something else to think about, but it's really important. Yeah, so basically moving that is the thing. I've just got a question here, sorry. So is there a downside in trying to use the highest value reset for future years? And the proportion of the funds accumulation, you pay more tax. Yeah, look, Brian, you're exactly right. So if you use a higher value for an asset, so let's say you've got a property, and property valuations are essentially arbitrary. The only true valuation for an asset is what the price is at is when you sell it. So a valuation or a valuer will give you what they think. That doesn't mean it's actually what it's worth. Now, I'm not going to go into the whole valuation of assets question because there's so much material and information around that as it is. But bear in mind, it's got to essentially be independent. It's got to be supportive and objective. They're the three big things. If you tick that off, then your valuation you can essentially probably live with. Now, the question here is, if you have an asset that might be $800,000 or $1 million, the other assets inside the fund, I'll pick on one, say that this fund has one member, it has a property, and it has some shares worth $1 million. Now, if we pick the $1 million value of the property, it now means our fund is worth $2 million. So that means $400,000 rolls back effective 30 June 17 to be in the accumulation phase. So now we have 1/5 of the fund being taxable. So going forward, they will pay more tax on that. Now, if they take extra money out of the fund, then you take that from the accumulation account. So then every year, the actuarial percentage changes a little bit. So you can sort of work with that over time. But I suppose, Brian, the view that we take here is that this relief measure is a one-off opportunity to maximise the capital gain of that particular, or to eliminate the capital gain on that property. So we're adopting the highest the highest value we can on these assets, because tax, you can potentially mitigate that or work with that over time. If you choose a lower value, yes, you means that you will pay lower tax going forward. But if you sell the asset in 2 years, is a different result than if you sell it in 10 years, which you will never know. So it is a little bit of an unknown, but basically that's the approach that we're taking. So option 2 is what most people have. That's where everything just sits in a big bubble, in a big pool, and you've got your pension and non-pension assets that sit in there, and you have your actuarial percentage works out your, you've got your original capital gains tax that sits in there. Sorry, you've got your exempt pension income actuarial calculation that kicks in when you split assets out when it's in a pool. But you get to use the CGT relief on every asset inside the fund, whereas under the segregated, you don't. Brian's just come back with a follow-up question, which is actually something I hear a little bit often, where it's after 10 years, don't we revert back to the original original capital gains tax cost base? Well, no, we don't. That was part of the initial proposal that was put forward. That actually never made it through to Parliament. So the 10-year window where you had to sell the asset within 10 years or realise the gain, that never actually made it in the legislation. That was part of the budget announcement, but not what was actually passed in Parliament. So that 10-year thing doesn't apply anymore. So ignore that. So unsegregated or proportional method, they overlap a little bit. So to qualify for proportional, as I mentioned before, a member has to have an accumulation balance. That's really it. If you've got a cease, if you've got a TRIS that hasn't ceased during the pre-commencement period. Now, calculating the notional gain, it's quite straightforward. With proportional, you can actually use losses as well. So you've got a notional loss that you can realise, because no different than because you've got an accumulation amount, the portion of the fund is taxable, you therefore get to offset your losses. Remembering, if you have 100% fund in pension phase, your losses you just lose. Whereas if you have a little bit in accumulation, you get to retain those losses or carry them forward. So the deemed purchase price is 30 June 17, and your ECPI calc is no different than what you would normally have done. So you go to your actuary, they come up with your calculation, and you will pay tax on whatever's taxable. And for capital gains tax purposes, you will defer, you have the option to either defer the capital gain or pay the capital gain in the 17 year. So deferring it means that when you sell that asset that it relates to, you actually get to realise the capital gain then that you realised in 30 June 17. So just think about that for a second, particularly the accountants. If you take over a fund, you're going to have to now ask for, did they apply CGT relief? Can you have a copy of any of their work papers for the deferral? Because you need to know that if they sell that asset, you need to be able to pick that up and put that in the capital gains tax schedule for whatever year that becomes. So that's going to be a lot of fun, can I just say. So proportional is by far the easiest to do. It really is. But that doesn't necessarily mean that it's the best option. So when things change, so as I mentioned, I've called this the corridor of uncertainty. And those that listen to ABC Cricket will know where I got that from. So if you go from unsegregated to segregated, so in other words, the members, so we have one member inside the fund, they start a pension after 9 November 2016. What happens? Well, basically, you don't get CGT relief, because remember, one of the preconditions for using the segregated method was that at 9 November 2016, the fund had to be fully segregated. Now, if you weren't fully segregated, but then you obtain an actuarial certificate that says, well, you're fully segregated, your exempt pension income percentage is 0, then you don't get to use the relief. So as you're doing the processing, looking at your client's situation, you really need to be thinking, okay, can I use the relief? What if something different would have happened, as far as pensions commencing, as far as the value of pensions commencing, all that sort of thing comes into the equation, because we didn't know as much back in November 16 as what we do today around all this. Things would have been done differently, I'm sure, from nearly every advisor, because as time has passed, we've actually appreciated what it means, and particularly now we're really getting into the detail. Seeing a lot of clients that went, oh, this is my last chance to put in $540,000, I'm going to put it in. But then that's then changed them from segregated to unsegregated. So there's been lots of movement between the two, more so than usual. And that's been, well, difficult to deal with, can I just say. So if you go from segregated to unsegregated, as I've mentioned, the assets are segregated at the start of the pre-commencement period, and the CGT relief is only available from 9 November 2016 up until when that segregation stops. So if they put contributions in on 1 June, then your segregation, your cessation date, has to be between 31 May and 9 November of 16. So you get to pick a date between those two dates, but you can't choose 30 June because you're 100% or the fund was 100% segregated at the 9th of November. So this is where a lot of machinations come into it, a lot of confusion comes into it, and where the technicalities really come into it when you're moving between these different scenarios, because as I mentioned before, so many funds, they put contributions in, or they were starting pensions because they thought it was the right thing to do, and it really just made it for quite interesting times. Also on the back of all this is a lot of people have retired or have said, well, actually, even though I was on a transition retirement pension, a TRIS, I'm actually retired. So that means that you've got to change their pensions. So when do you do that? Do you do that at 1 July? Do you do that as part of the CGT relief measure? Because if you're on a TRIS, that's an automatic condition, if you like, to change your to trigger CGT relief. So you don't want to do it too early because you might not be able to actually use the relief measures. So all these things come into it as far as the detail about, am I eligible to use CGT relief? There was an auditor, I think, from one of the second tier firms down in Melbourne, and he was saying that 60% of all CGT relief funds he's seeing are actually ineligible. So in other words, they're saying, no, you're not eligible for relief, you've got to hand it back. I'm expecting a lot of audit activity from the tax office around this, because if people are getting it wrong, then the tax office will want to clean that up as quickly as they can, because it's future lost revenue for them. Yes, it's revenue they wouldn't have got if we hadn't have these super changes, but they'll want to make sure that they're milking the cow as hard as they can. And look, that's how the law works too. So some considerations. So the pre-commencement period, are all the assets segregated? So some of you who listen to webinars that I've done before, I use bucket analogies a fair bit because I think that works really well. Everyone knows what a bucket is. You fill buckets up, you empty buckets. I'm using a lot of timelines this year. So the first thing that my accountants do when they're doing a job that has CGT relief applied, they do a timeline. So we look at what was the status of the fund as at 9 November 16, put it on the timeline. Were contributions added? They put that on the timeline. When, what was the cessation date? They put that on the timeline. So it all gets put on there. So then I can look at it and say, yep, I'm happy with all these decisions that we've made along the way and that we're getting the best result for our client. So the first thing is, at the pre-commencement period, are all the assets segregated? Were there any rollovers, contributions? You think about the ATO issuing the co-contribution or the lost super refunds, things like that can just throw you out. And we've had that. The cessation date, use the date prior to when the contribution or rollover happens. So that way the fund will be unsegregated from that time forward. Hopefully it's not too early in the financial year or in that pre-commencement period, because otherwise then it might not be worthwhile you using CGT relief because of the income tax outcomes that are going to come. When any new pensions started, and basically, what was the capital, the pension purchase price for those? You've got to bear in mind Part 4A around all this. You've got to make sure that the commencing a pension on a particular time is essentially what the fund has always done. That someone hasn't contrived an outcome by just saying, "Oh yes, we've started a pension. Here's the paperwork." But is there history of that? Is that a normal thing for that fund to do? Because you don't want to get into Part 4A territory. And it's not always the case that you want to use CGT relief. It's not always the right thing to do. You might be locking the client into a tax position that might not be get realised. They might be looking to sell the assets or wind the fund up. So what's the point of going through the process? That time, energy, and effort in doing all this might be irrelevant to them. So really understanding what your client outcome is important, along with a financial advisor, because they might have certain ideas around all this stuff too. So it's important to have them engaged in the process. So it's a bit of a recap: segregated versus unsegregated or proportional. So segregated is when you have, there's no capital gains on the reset. So when you refresh your cost base, that's it, no tax. And the fund has to be fully exempt from income tax at that date, at the cessation date, and also at 9 November 16. The reset purchase price for the CGT discount, so once again, you lose that discount for the 12-month period. So if you pick 1 January, yes, the CGT discount applies from 1 January this year. And if a date other than 30 June is used, you need to get an actuarial certificate for the cessation period. Now, typically what we've always done as accountants, and I've been doing this for almost 20 years, is that you get an actuarial certificate for the full 12-month period. So you go to your actuary, say, right, give us the certificate, beautiful. And that applies if say, a member put extra money into the super fund. So they have fully in pension phase, they put extra money in, you get a certificate, it does the full year. Well, last year, the tax office came out and said that's wrong. So everything that we've been doing as an industry for the last 20 odd years is wrong. We actually should only be obtaining a certificate for the period of when the contribution went in, so when it became an unsegregated fund, through to 30 June 17. Now, there was lots of backwards and forwards after the ATO released their position on this. The Institute of Actuaries weighed in, the accounting bodies weighed in. Everyone was saying that, surely that can't be the case, because that means you have to prepare 2 sets of financial statements, which in a way you do, because you need to know what the balance is when you at the CSA when it stops being segregated, and obviously 30 June. When all that was going on, it was, I suppose, quite early in the financial year. As a firm, we made the decision that we are going to run the 2 methods. So we actually request a certificate from the cessation date through to 30 June 17. Now, the ATO then came out and said, yes, that's what you've got to do, but for the 17 year, we will actually give you some a transitional relief. So you can keep on doing what you have been doing, or you can use the way that it should be done, according to them. So you can use either or. As I said, we do it as the ATO want us to do it going forward. So for us, there'll be no change in process because we've already done that now. So just something to bear in mind, that you need to get that actuarial certificate. For non-segregated, you are realising a capital gain on the reset, and also a capital loss. You are locking in a tax position. So that tax will be payable regardless of what happens to that share moving forward. So if it goes nowhere, the tax will still be paid on what you've put in that tax return. If it drops in value, and you sell it, then obviously you get the loss on one side,
but then you get the gain on the other side because you've already realised the gain. So, you're committing to a tax position. Let's be clear about this. You are committing to a tax position. So there is a bit of crystal ball gazing. You've just got to hope that that's the right thing to do. It's included in the 17 tax return or deferred until the asset is sold. And the CGT discount rule still applies. That hasn't changed. And also the ECPI process remains as it has been. So to reset or not reset, that is really the golden question. So the discount comes into it. So is there going to be a benefit if you reset? Is that discount going to make a material difference to things? Not being able to use that if they sell an asset within the 12-month period. What are the age of the members? Are they currently in accumulation phase? Are they likely to move to pension phase? So if you have one member that's in a TRIS, he has $1 million, you can use CGT relief, but if he retires fully and he's not going to put any more money in, well, what's the benefit for using CGT relief? Now, we have some clients who have used CGT relief when they're in transition to retirement and they have less than $1 million because they plan on putting money into super that will get them above 1.6 million at some point. So then they might as well make the best of the relief now while it's available, because it is a one-time only opportunity. Rollovers and contributions, are they going to come in that will impact either the ECPI going forward or the balance of the fund just generally? The capital reduction, does the member plan on pulling money out of super, putting their personal name into a family trust, something like that, to get them to below 1.6? Members looking, as I mentioned, retiring, lump sum drawdowns. Are they invested in high growth assets? So their balance might go from $1 million to 1.6 in 3 years. These are all very specific questions for the fund that you need to either ask the client, their advisor, and determine what's the best outcome. This is an irrevocable election. I had a client that we were had some unlisted shares, and we're talking about the value. And I said, well, if we use one value, because there was some contrary positions around as to what the value of this private company was. I said, well, if you use one value, that means you'll be above $1.6 million. So then you get to use the CGT relief. If you use the other value that's being thrown around, then you'll be below and you won't get to use CGT relief. So that's great for now. But what if your wife is also in the same position? What if one of you die? Then in the fund going forward, half the assets will be taxable. If you're not in a position to use CGT relief. So all these things come into it. It's not just the now, but it's also, what if someone dies? Because you're going from a fully exempt fund being at 1.5, let's say, to a fund that is essentially 50% taxable if one of the members dies, where we could have used a slightly higher value, used CGT relief. Yeah, there would have been a little bit of tax up until whatever point, but then when that estate implication occurs, there's no tax going forward, or not as much tax going forward. So all this sort of decision making and our analysis has to come into it. And just remember too, there is a disconnect between the whole CGT relief, so the value of the rollback. It needs to comply with the transfer balance cap provisions. Now, the transfer balance cap provisions is 1.6 million at retirement at 30 June 17 or 1 July 17. Now, if you pick a value, if you roll back a portion of the fund at the cessation date, let's call it 1 January 17, then there's still 6 months worth of asset values to go through. Now, if you roll back if say the fund had $2 million, you roll back the 400,000 at 1 January 2017, by the time that we come through to 30 June 17, the value of that pension might be more or less than 1.6 million. So I mentioned before about how we sort of work out, okay, the value of the assets is this, we work backwards to say what we actually need to roll back for CGT relief purposes. You can do $1. You can roll back $1 and get the best possible tax outcome for your client. However, Part 4A kicks in. You have to remember that you're doing this to comply with the transfer balance cap requirements. Rolling back $1 does not do that. There's got to be a process around it. There has to be a reason why you're rolling back what you are rolling back. So any avoidance provisions. So as I mentioned, Part 4A a couple of times here. So think about the amount that you're transferring back. Think about the asset valuations that you're using. Did you commence trees retrospectively so you could utilise the measures? All these things come into it. So you can either use relief or reduce the ECPI calculations, and changing things like contributions to rent or something like that, depending on the fund. All that stuff comes into it. Are you actually doing something that could potentially be a red flag for Part 4A? So things that need to be considered. And I mentioned some examples. Just excuse me for a tick. So in the next 4 examples, I'm going to be using the same scenario where we have one SMSF with 2 members, Edward and Jackie. Edward's balance is 2.3 million, Jackie's got 2 million. Okay, so they're both over the 1.6. There is a property inside the fund worth 3.2 million that has a $1 million capital gain on it. It has some shares in there, about $1 million worth. Capital gain on that is 200,000 if it's sold on the 1st of April. If we wait until 30 June, that drops to 150,000. We've got some cash in there as well. Rental income is about 200,000. Dividends and interest is 100,000. So let's have a look at option 1. Now, option 1 was where we keep the pools separate. So we've got both an account-based pension prior, so both are in account-based pensions prior to the pre-commencement period. So that's ticked. Relief we can use. So if we go through and we only are moving assets from the pension pool to the accumulation pool so we can get relief, we go through and say, right, which ones are we going to use? So, we're looking at, so for shares, we've got at 1 April, 200,000, at 30 June to 150,000. So that means that for the discounted relief, it's 20,000 or 15,000, 10%. Taxable income, so $25,000 if we use 1 April. That's because the fund has derived $100,000 worth of income from the shares, and I'm just saying divide that by 12 months, multiply it by 3 months for the April, May, June, which means that we've got tax payable of $3,700 if we pick 1 April. If we pick 30 June, we actually don't pay any income tax, but we get a higher capital gains tax relief measure. Under option 2, so that's where we get to use the shares and the property. So now we have relief of 1.2 million, and if we use 1 April, or if we use 30 June, we have 1.15. The relief is there. Taxable income, once again, now $75,000 because now we're including the property income into this equation. Divide by 12, multiply by 3. But then we get to use our ECPI because not all of because a portion of the fund is still exempt from tax between 1 April and 30 June. So 75% of that $75,000 is tax-free. 25% is taxable. Hence why we get $2,800 worth of tax. So as you can see, we actually get a better result in this situation if we use option 2, the pooled method, as opposed to option 1. So let's assume in this example that Edward has a pension of 2.3 million and Jackie has 2 million sitting in her accumulation account. So what that looks like is that Edward has 1.6 in pension and 700,000 in accumulation, and Jackie has her 2 million inside inside accumulation. So capital gains tax relief, because it's unsegregated, we have to use proportional. 30 June is the only date we can use. So that means we have relief of 1.15 million. So the relief is 115,000. ECPI is 53% because essentially half the fund is, just a little bit over half the fund is tax-free, fair bit's taxable. So that actually means that in this situation, we are deferring a $61,500 capital gain until a later point. Or we can realise it now. They can pay the tax now on that, or they can offset it against other losses they may have, or they can defer it until the asset is sold. For me, you defer it until it's sold because that's when you have the cash, when you sell that asset. And if you don't take any action, so let's say in this situation, the client sold the property on the 1st of January 2018 for 3.2 million, what we had on the books. So given the Edward, he had 1.6 million in account-based pension, 700 in accumulation, no different. This time we're actually going to say that Jackie started a pension back in 1 July 17 on 1.6 million, so she has 400,000 in accumulation. So now, because most of the fund is still exempt from tax, about 75%, it means that the tax liability will be 25,000. So if we would have back here, before Jackie had actually started the pension, if we'd used relief, we would have been paying capital gains on 61,000, whereas over here, we've got 25,000. So by not doing something, sometimes you can get a better result. Now, remembering too, back here, we could have used the relief just on the shares, not do the property, and then let the property just fall out after the pension had commenced. So different funds, different scenarios will give you different outcomes. So it's important to be mindful of all of that. And as I mentioned, capital losses, if you're using the proportional method or the unsegregated method, whatever you want to call it, as at 30 June 2017, because you have accumulation balances in the fund, you can defer capital losses. So just something to be mindful of. So in summary, determine if the fund is actually eligible. Does a member have more than 1.6 million inside a pension? Remembering that going forward, TRIZs are no longer retirement phase products. Or do they have a TRIZ? Now, they don't have to stop the TRIZ, it can keep on going. But having a TRIZ is a mechanism that you can use CGT relief on. Determining the type of ECPI that you're going to do. Is it segregated or proportional? Look at the type of method that you'll be using. So once again, segregated or proportional, looking at the transactions that have happened. You don't know any of what's happening with the capital gains tax relief measures until you've processed all the transactions inside the fund and you know what's happened. Then you make your market assessment. Discuss it with the client, discuss it with the financial advisor about what's going on, what their intentions are, and that sort of stuff. And then you've got to process the election. Remembering too, as an accountant, you need to give the client the information about the CGT relief because ultimately they're responsible for it and they have to keep the records. So we actually give our clients quite a reasonable size report that goes through the different methods of capital gains tax relief and then the outcomes that we've used. We mentioned the dates, if it's segregated and the best outcome and what those different dates meant as far as an outcome goes. And that's sort of about it as far as CGT relief. Now, as I mentioned at the outset, this is a really complicated area for those that are involved in it. If you would like a second pair of eyes looking over what you've done and the process you've done, more than happy to do so. You know, that is what we do. we do that for some of our clients. We help them with, even picking the dates depending on, if we are able to do that efficiently and easily, or producing the reports for them. We can help with all of this sort of stuff because it is hard. It is really hard, and we've got best part of probably about 15% of our client base, some 100 funds going through this process. So we've got our heads reasonably around it, but it is not an easy process. So don't be afraid to contact us if you would like us to have a look or talk to you about it, because ultimately that's what we're here for. So thank you for listening in, and good luck with it. All right, thank you.